Imagine waking up tomorrow and discovering you lost a $20 bill from your pocket. Not stolen in a dramatic way, just gone, slipped out sometime yesterday. You feel annoyed. Maybe you scan the floor, check the laundry. That small sour feeling sits with you through breakfast. Now imagine instead that you found a $20 bill on the sidewalk. You feel a little lucky, a little pleased. But here is the strange thing. The unhappiness from losing that 20 is almost certainly stronger than the happiness from finding it. Most people, if asked, would say they need to find at least $40 to cancel out the sting of losing 20. The pain of losing is more than the joy of winning, and this is not just a personality quirk or a sign that you are pessimistic. It is one of the most well-documented patterns in all of behavioral science. It has a name: loss aversion. And it quietly shapes nearly every financial decision you make. From whether you sell a stock, to whether you take a job offer, to whether you stay in a relationship that is no longer making you happy. Loss aversion was first formally described by the psychologists Daniel Kahneman and Amos Tversky in 1979 as part of a larger theory called prospect theory. They were trying to understand something that traditional economics could not explain. Standard economic models assumed that people are rational calculators who weigh gains and losses evenly, that a $1 gain and a $1 loss have equal but opposite emotional weight. But Kahneman and Tversky observed that people consistently refused perfectly fair 50-50 bets. Here is the simplest version. Imagine I offer you a single coin flip. Heads, you win $100. Tails, you lose $100. Would you take that bet? Almost nobody does. And yet, if you think about it from a purely mathematical standpoint, the expected value of the bet is 0. You have a 50% chance of gaining 100 and a 50% chance of losing 100. 0 times 100 plus 0.5 times 100 plus 0.5 times negative 100 equals 0. The bet is fair. A rational calculator would be indifferent. But actual humans are not indifferent. They feel the potential loss much more acutely than the potential gain. In study after study, researchers found that for most people, the pain of losing $100 feels about twice as intense as the pleasure of winning $100. They call this the loss aversion coefficient. It is typically around 2. Losses hurt about 2 times more than equivalent gains feel good. Let me give you a concrete sense of what that means in emotional terms. Researchers have used various methods to measure the subjective emotional impact of gains and losses. In one classic experiment, participants were asked to imagine a scenario where they either gained or lost a certain amount of money. They then reported how happy or unhappy they would feel on a scale. The results were striking. Gaining $100 increased happiness by about 15 units on average. Losing $100 decreased happiness by about 25 units on average. That is a ratio of roughly 1.67. But when the stakes went higher, the ratio climbed even more. For a gain or loss of $500, the emotional impact of the loss was roughly 2.25 times stronger than the gain. The pattern held across cultures, across income levels, across age groups. It appears to be a fundamental feature of human psychology. So where does this come from? There are several theories. One is evolutionary. For our ancestors, a loss was often a matter of life and death. Losing a food source could mean starvation. Getting injured could mean death from infection. Gains were nice, extra food, a better shelter, but they were rarely as urgent as avoiding a loss. The brain evolved to treat potential losses as emergencies. The amygdala, the brain region responsible for fear and threat detection, activates more strongly when we anticipate a loss than when we anticipate an equivalent gain. Dopamine pathways that signal reward fire more weakly for gains than the stress pathways fire for losses. The nervous system is literally wired to feel losses more deeply. Another theory is cognitive. Losses are unexpected in a way that gains are not. We tend to adapt to our current state as a reference point. When something good happens, we update our reference point upward. But when something bad happens, we feel the deviation from where we were. The asymmetry may come from the fact that we are comparing downward deviations against upward deviations from a stable baseline, and the brain treats downward deviations as more informative. Whatever the cause, the effect is real and measurable. But here is where it gets truly interesting. Loss aversion is not just about money. It applies to time, it applies to effort, it applies to relationships, it applies to status. It applies to almost any domain where humans track gains and losses. Consider the endowment effect. This is the phenomenon where people value something more once they own it. In a famous experiment, Kahneman, Netsch, and Thaler gave half the participants in a room a coffee mug. The other half got nothing. Then they offered the mug owners the chance to sell their mug, and the non-owners the chance to buy one. The average price mug owners demanded to give up their mug was about $7. The average price non-owners were willing to pay to acquire a mug was about $3. Both groups were looking at the same mug. The difference was entirely due to ownership. Once you own something, losing it feels more painful than the pleasure of gaining it would have been. This is loss aversion operating through the lens of ownership. And it is not just about mugs. People show the endowment effect for stocks they own, for houses they live in, for jobs they hold, for opinions they hold. The mere fact of possession amplifies the pain of loss. Now let me walk you through how this plays out in real financial behavior. Imagine you buy a stock for $100. The stock rises to $120. You feel good. You are up 20%, but then the stock falls. It drops to $95. You are now down $5 from your purchase price. That $5 loss feels much worse than the $20 gain felt good. Here is the problem. Your rational mind knows that the purchase price is irrelevant to the stock's future prospects. The only question that should matter is whether you would buy the stock today at $95. But your loss-averse brain cannot let go of that $100 anchor. You hold the stock, hoping it will recover. It drops further to $80. Now you are down $20. The pain is even worse. You tell yourself you will sell when it gets back to $100, but it never does. 3 years later, it is trading at $60. That is the sunk cost fallacy in action. It is loss aversion combined with the inability to accept that a loss has already occurred. The decision to sell is not just a financial calculation. It is an emotional admission of defeat, and your brain will bend over backward to avoid that admission. Here is the hard number. Researchers have studied the trading behavior of individual investors and found a consistent pattern. Investors are much more likely to sell stocks that have gone up than stocks that have gone down. This is called the disposition effect. It is widespread. One study of 10,000 individual brokerage accounts found that investors realized gains about 50% more often than they realized losses, even though the losses were larger on average. They were locking in small gains while holding onto large losses. The math is brutal. Let me give you an example. Suppose you buy 2 stocks for $100 each. Stock A rises to $110. Stock B falls to $90. A rational portfolio rebalancer would ask which stock has better prospects going forward. But a loss-averse investor sells stock A, booking the $10 gain, and holds stock B, hoping it bounces back. This is exactly the wrong move if stock A has better fundamentals. The loss-averse investor is systematically selling winners and holding losers, which over time leads to lower returns. You are literally paying a psychological tax on your portfolio. Let me give you the concrete numbers so you can feel the cost. Imagine you make this mistake once per year over a 30-year investing career. Each time, the stock you sell too early goes on to gain an additional 10% in the year after you sell, and the stock you hold too long goes on to lose an additional 10% before you finally give up. With a starting portfolio of $10,000 and annual contributions of $5,000, the difference between the loss-averse strategy and the rational strategy over 30 years is roughly $120,000. That is the cost of letting loss aversion drive your trading decisions. It is not a small effect. It is measured in years of retirement income. This pattern shows up in other domains too. Consider job changes. People stay in jobs they dislike because the thought of losing the security of a known salary feels worse than the potential upside of a new opportunity. Researchers have found that the average person requires roughly a 30% salary increase to consider switching jobs, even when they are unhappy in their current role. The pain of losing the known paycheck outweighs the pleasure of a potentially better one. The same logic applies to relationships. People stay in unsatisfying relationships longer than they should because the thought of losing the companionship, the routine, the social identity of being partnered feels worse than the potential upside of being single or finding a better match. The status quo bias, which is closely related to loss aversion, keeps people stuck in suboptimal situations for years. But here is the part most people get wrong. They think loss aversion means they should avoid risk entirely. That is a mistake. Loss aversion does not mean all losses are bad. It means the emotional weight of losses is disproportionate. And if you understand that, you can design your decision-making to compensate. Let me show you a concrete example. Suppose you are offered a 50-50 bet where you can win $200 or lose $100. The expected value is positive. 0.5 times 200 plus 0.5 times negative 100 equals $50. On average, you will make $50 per bet. Most people still refuse this bet. The 2-to-1 ratio of gain to loss is not enough to overcome loss aversion for many people, but you need to know your own number. For some people, the break-even ratio is 1.5. For others, it is 2.5. The point is that there are many positive expected value bets in life: starting a business, investing in a volatile but promising asset, changing careers, and loss aversion makes you systematically avoid them. The error is not that you are risk-averse. It is that you are risk-averse beyond what is rational. Let me walk you through a structured way to think about this. Imagine you are considering whether to leave your current job for a startup. Your current job pays $90,000 a year. The startup job pays $70,000 plus equity. The equity could be worth zero, or it could be worth several $100,000 if the company succeeds. Your loss-averse brain focuses on the immediate $20,000 income loss. That feels concrete and painful. The potential upside feels abstract and distant, but you can reframe the decision. Instead of thinking about losing $20,000, think about purchasing a call option on the startup's success. You are paying $20,000 of reduced salary to buy a lottery ticket with positive expected value. The question is not whether you are losing $20,000. The question is whether the equity you receive in exchange is worth more than $20,000 in expected value. That is a much clearer calculation. Here is another tool. Precommitment. When you know your loss-averse brain will make bad real-time decisions, you can design rules that override your instincts. Dollar-cost averaging into the market is one example. By committing to invest a fixed amount every month regardless of market conditions, you avoid the loss-averse tendency to sell after a drop or wait on the sidelines after a run-up. Automatic contributions are a form of pre-commitment. They remove the decision point where loss aversion would interfere. But let me be honest with you. Loss aversion is not something you can eliminate. It is wired into your nervous system. What you can do is recognize when it is operating and build countermeasures. The first step is simply naming it. When you feel that visceral reluctance to sell a losing stock, say to yourself, "That is loss aversion. That is my brain treating this $500 loss as if it is a catastrophe." It is not. It is a small setback in a long game. The second step is to reframe the reference point. Instead of measuring from your purchase price, measure from the current price. The question is not whether you have lost compared to your entry point. The question is whether you would buy the asset today at its current price. If you would not, sell it. If you would, hold it. That simple reframe neutralizes much of the endowment effect. Here is something surprising. Loss aversion changes with age. Older adults show stronger loss aversion than younger adults. Researchers have found that the loss aversion coefficient increases gradually across the lifespan. In one study, the average loss aversion ratio for people in their 20s was about 1.8. For people in their 60s, it was about 2.6. This makes evolutionary sense. Older adults have accumulated more resources and have less time to recover from losses. Their brain adapts accordingly. But it also means that the advice that works for a 25-year-old, take aggressive risks, ride out volatility, may be psychologically unbearable for a 60-year-old. The right strategy depends not just on your financial capacity for risk, but on your psychological capacity for loss. There is a fascinating cross-cultural dimension to this as well. Researchers have measured loss aversion across dozens of countries. The general pattern holds everywhere, but the magnitude varies. People in more individualistic cultures like the United States tend to show slightly higher loss aversion than people in more collectivist cultures like Japan. One theory is that collectivist cultures have stronger social safety nets, so individual financial losses feel less catastrophic. There is also a gender difference. Women tend to show slightly higher loss aversion than men, though the gap narrows when controlling for income and wealth. This is not a value judgment. It is a descriptive fact, and it matters for financial planning. A one-size-fits-all investment recommendation is worse than useless if it ignores the psychological reality of the person receiving it. Let me give you one more concrete mechanism to anchor this. Imagine you are offered the following gamble. You can win $300 with a 50% chance, or lose $100 with a 50% chance. The expected value is $100. Most people take this bet. Now imagine a different gamble. You can win $150 with a 50% chance, or lose $100 with a 50% chance. The expected value is $25. Most people refuse this bet. Now here is the key insight. Both bets have a gain-to-loss ratio of 3-to-1 in the first case and 1.5-to-1 in the second case. The threshold where people become willing to take the bet is roughly when the potential gain is about 2 to 2.5 times the potential loss. That threshold is your personal loss aversion ratio. You can calculate it for yourself. Find the smallest amount you would need to win in a 50-50 bet against a $100 loss to make the bet feel worth taking. If that number is $250, your loss aversion ratio is 2.5. If it is $150, your ratio is 1.5. Knowing your number gives you a benchmark. When a bet has a gain-to-loss ratio higher than your number, you should take it. Your emotions are lying to you about the risk. Now let me shift to a broader implication. Loss aversion does not just affect individual decisions, it shapes entire markets and economies. Consider the equity risk premium, the extra return that stocks have historically earned over risk-free assets like government bonds. Economists have long debated why this premium is as large as it is. One prominent explanation is loss aversion. Investors hate losses so much that they demand a substantial premium to hold volatile assets. The equity risk premium is, in part, a compensation for the psychological pain of drawdowns. If investors were rational calculators with no loss aversion, the equity risk premium would be smaller and stock prices would be higher. Loss aversion literally changes the price of every publicly traded asset on the planet. It also shapes consumer behavior. Companies know that losses loom larger than gains, and they design their pricing strategies accordingly. Free trials are a classic example. Once you have used a service for 30 days, losing access to it feels like a loss. The company is not asking you to gain a new service. They are asking you to avoid losing one you already have. The endowment effect makes you more likely to subscribe. Subscription models in general exploit this asymmetry. It is harder to cancel a service than it is to never have subscribed in the first place, because cancellation feels like a loss. The same logic applies to loyalty programs, to premium features that you try for free, to teaser rates that expire. Every time a company offers you something free or discounted, they are banking on loss aversion to convert you from a trial user to a paying customer. Here is a less obvious domain. Politics. Loss aversion helps explain why voters are often more motivated by what they might lose than by what they might gain. Political campaigns that emphasize threat, the other candidate will take away your benefits, your rights, your way of life, tend to be more effective than campaigns that emphasize opportunity. This is not cynical manipulation in every case. It is a reflection of the same psychological asymmetry. Fear of loss is a stronger motivator than hope of gain. Good political leaders know this and use it. Bad political leaders exploit it. The difference is whether the threat is real or manufactured. Public health messaging uses the same principle. Messages that emphasize the potential loss from not getting a vaccine, you could get sick, you could miss work, you could infect your elderly parent, are more effective than messages that emphasize the potential gain from getting vaccinated. This has been validated in dozens of studies. Gain-framed messages work better for prevention behaviors like exercise or sunscreen use. Loss-framed messages work better for detection behaviors like cancer screening or vaccination. The asymmetry is domain-specific, but it is always there. Now I want to make a distinction that is important. Loss aversion is not the same as risk aversion. They are related but different. Risk aversion is about preferring a certain outcome over an uncertain one, even when the uncertain one has a higher expected value. Loss aversion is about the asymmetry between gains and losses. You can be risk-seeking for losses and risk-averse for gains. In fact, that is exactly what Kahneman and Tversky found. When people face a sure loss, they become risk-seeking. They gamble to try to avoid the loss. This is why people hold on to losing stocks too long. The sure loss of selling at a loss feels so bad that they gamble on a recovery. The same person who refuses a fair coin flip for a gain will take an unfair coin flip to avoid a certain loss. This reversal is one of the most powerful predictions of prospect theory, and it has been confirmed in hundreds of experiments. Let me give you the numbers. Imagine you face a choice. Option A, a sure loss of $50. Option B, a 25% chance of losing $200 and a 75% chance of losing nothing. Which do you choose? Most people choose option B, even though its expected value is negative $50, the same as the sure loss. 25% times negative 200 equals negative 50. The expected loss is the same. But the possibility of losing nothing is irresistible, even though the possibility of losing 200 is terrible. The brain hates sure losses and will gamble to avoid them. This is the same mechanism that drives people to chase losses at a casino. It is called the gambling for resurrection effect, and it is one of the most destructive patterns in financial behavior. So what do you do about all of this? You cannot change your wiring, but you can design your environment to work with your wiring rather than against it. Here are a few practical strategies. First, pre-commit. Set rules in advance that remove the decision point. Automate your investments. Set stop-loss orders on your trades. Create a rebalancing calendar. When the market drops and you feel the urge to sell, your pre-commitment rule overrides your instinct. Second, reframe the reference point. Do not measure from your purchase price. Measure from the all-time high or from your financial goals or from the alternative use of the funds. Any reference point other than your entry point weakens the endowment effect. Third, use a decision checklist. Before making any financial decision, ask yourself, if I did not own this asset, would I buy it today at the current price? If the answer is no, sell it. If the answer is yes, hold it or buy more. This is the Warren Buffett test, and it works precisely because it bypasses the reference point that triggers loss aversion. Fourth, calculate in expected value terms. When you face a risky decision, write down the possible outcomes, their probabilities, and their values. Do the multiplication. The expected value is the average outcome if you repeated the decision many times. That is the number that should guide you. Your emotional brain will scream that this time is different. It is not. The math works over the long run if you take enough shots. Fifth, separate the decision from the outcome. A good decision can have a bad outcome. Selling a stock at a loss because its fundamentals have deteriorated is a good decision even if the stock miraculously recovers the next day. You made the right call with the information you had. The outcome is irrelevant to the quality of the decision. Loss aversion makes you judge decisions by their outcomes. Do not. Judge by the process. Let me wrap this up with a final reflection. Loss aversion is not a flaw. It is a feature that helped your ancestors survive, but the world your brain evolved for is not the world you live in. In the ancestral environment, a loss of food or shelter could be fatal. Survival required extreme caution. In the modern environment, most financial losses are recoverable. A 20% market drop is painful, but historically the market has recovered every time. A lost job is stressful, but most people find new ones. The stakes are lower than your brain thinks they are. The challenge of modern life is to recognize when your ancient wiring is giving you bad advice and to build systems that override it. Not because your instincts are stupid. They are not. They were perfect for a world that no longer exists. The goal is not to eliminate loss aversion. It is to stop letting it make your decisions for you when the consequences are higher than they need to be. So the next time you feel that sick feeling in your stomach when a stock drops, or when you are about to sell a losing position, Or when you are deciding whether to make a change that could go wrong, pause. Name it, loss aversion. That is what you are feeling. It is a signal from a part of your brain that does not understand modern markets or modern probabilities. Listen to it. Thank it for trying to protect you. And then make your decision based on the numbers. Not because the numbers are always right, but because they are more right than your gut when your gut is calibrated to a different world. That is the calm, clear-eyed approach that separates good decision makers from the rest. And it is available to you, starting right now, with the next decision you face.